Hi, and welcome to my monthly market insights video. My name is Dan Timitich. I'm one of the managing principals and portfolio manager at T2 Asset Management. Before we get started, just a reminder, this video is for educational purposes only. Opinions expressed in this video are mine, do not reflect the opinions of other portfolio managers. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, the final video of 2019, so let's get to it. Last month, we talked about the markets hitting new highs seemingly every day and how risk management is not on anyone's mind. Why would it be? I mean, markets only go up, right? Well, this month, I thought we should expand on the importance of not getting too complacent as the markets continue to grind higher. Market bulls were in control in November, and they point to a number of factors that will continue to add to market gains. They point to the relentless new highs that the market has made. Analysts continue to claim the outlook is improving for next year. From a seasonality perspective, December is typically a good month for stocks, although last year was clearly a disaster, but we'll get into that later. Markets tend to do well during presidential election years, and with the 10-year Treasury at about 1.8%, there are no other alternatives. While all of these points have some merit, none of them have anything to do with fundamentals, and I would caution investors to pull back the lens a bit and take a look at the bigger picture. This month, we're going to reflect on the last 2 years to give you a better perspective of where we currently stand. Before we get into that, I wanted to touch on risk management. I addressed this last month, but I think it's important to repeat. First, risk management is not market timing. It's about quantifying risk. That's so that you can increase and decrease your stock exposure that's based on objective factors and minimize those emotional decisions that many people make that could really lead to some disastrous results. If you do it correctly, you could really smooth out your returns and you could feel more like this and less like this. For those of you that still believe you need to write out all of the ups and downs in the market, risk management probably doesn't matter much. But for those of you that are nearing retirement or are in retirement, you need to ask yourself an important question. Do you have enough time to recover? Maybe you do, maybe you don't, but you may want to go ahead and revisit my video from last month on risk management to get some ideas. Okay, we're going to take a walk down memory lane this month. Here we have a chart of the S&P 500 for the first 9 months of 2018. We had some problems in the beginning of the year, but we recovered nicely, and the market was up right around 9% by the end of September. Everyone was feeling good about the markets, the economy, just about everything. Each time you turned on the TV, experts were telling you everything was great and nothing could derail this market. As a matter of fact, they were calling for 3 to 4 additional rate hikes from the Fed in 2019 because the economy was so strong. Well, they clearly got it wrong. After hitting an all-time high back in September, the market reversed course and fell nearly 22% from September to December and finished the year down 6%. I do need to give credit to my partner Ken Tomko, our chief technical analyst, for identifying this breakdown in the market and recommending us moving to a defensive position. As a matter of fact, his tactical equity model finished positive in 2018, which is quite the accomplishment. So what really happened? Did the market suddenly have some sort of nervous meltdown? No, there were signs that storms were brewing, but most people just simply ignored them. The Fed was clearly overdoing it with rate hikes, and the fact that all market pundits were expecting some more rate hikes in 2019 should have been a clear warning sign. I pointed this out last year in October and November, so people shouldn't be really surprised. We also had the House of Representatives flip from Republican control to Democrat control, and that spooked the markets. And finally, we began to see signs of economic weakness. If you combine all three of these factors, we had a perfect storm that resulted in a big sell-off to end the year. So is there anything we can glean from 2018? I do think so. Mark Twain once said, history doesn't repeat itself, but it often rhymes. So let's take a look at 2018 versus 2019. We're going to compare and contrast some major factors to get a better, more comprehensive picture. First, the Fed. In 2018, Fed was raising rates, and in 2019, they were cutting rates. In 2018, the economy was strong, and in 2019, we began to see some cracks and economic data was weakening. Earnings in 2018 were extremely strong, but 2019 brought much weaker earnings. Tariffs on China were imposed last year, and now we have potential for additional tariffs coming. Politics, they were ugly in 2018, and they didn't get any better in 2019 with the start of the impeachment hearings. Also in 2018, market valuations were pretty fair at about 19 times trailing earnings, but with the market run up in 2019, it's gotten quite expensive at 23 times. Taken as a whole, the market sell-off of nearly 22% in 2018 from its peak, but the biggest pullback we had in 2019 so far was only about 8%. If we were to color code these factors to show a positive or negative for the markets, we can clearly see that 2019 has significantly more negative factors than 2018, and yet we haven't even seen a 10% pullback yet. It seems to me that everyone is betting on China, on a China trade deal, and ignoring the warning signs again. Do I expect a complete market meltdown? No, I don't. But if your only investment thesis is a China trade deal is all we need to move higher, then don't be surprised at what happens if we don't get a deal done. Look, if there's always something to worry about in the markets. I understand that, and most investors worry about things when markets start to sell off. On the contrary, I worry about the market when it gets way ahead of itself. Today, I feel like people are ignoring risk management. Many people do ignore risk when the market is rising every day and they feel good about themselves and the market. But now is not the time to be going all in. If you follow markets like I do, you can see increasing complacency. I've often said that markets will swing from fear to greed like a pendulum. Well, today I'm concerned that there are a lot of people out there who have a fear of missing out. And finally, the China trade deal. Everyone is under the impression that we are going to get some sort of phase one deal done, and we can all sit around the campfire singing Kumbaya. Who knows? Maybe these people are right. I just wouldn't bet my retirement on it, and I hope you wouldn't either. Since this is the last video of 2019, I'd be remiss if I didn't thank all of my clients for their trust and confidence. I certainly hope these videos, at a minimum, give you something to think about. On behalf of everybody here at T2 Asset Management, I want to wish everyone a wonderful holiday season and a prosperous new year. We had a wonderful year in 2019, and I hope that you continue to watch us. Thank you, and we'll see you next year.